Thank you very much. I think it's been a great start to the entire IVCA summit with Amit Jain starting off, giving us nuggets on what's really happening in India, how are buyouts being seen as compared to the Western world, the whole product market fit, and so on and so forth. We had some interesting insights from Manish and Vimalji in terms of how the relationship between the family and the investing fund really plays out and value creation happens. With us now, we have, I would say, three real stalwarts. Collective experience of value creation amongst them would be, I think, something that we all look forward to learning from. We have Amit. Amit leads portfolio operations for Blackstone in Asia, Amit. So we'd like to hear from you, your experience, not just in India, and how do you compare that across markets. We have Ashish. Ashish again leads a lot of value creation work across Asia with a big focus on India, obviously. And we have Param, who leads portfolio value creation for ChrysCapital in India. Thank you so much for this time. Amit, starting off with you, we know the context. We've seen, obviously, the big focus on buyouts and really, more than 20% of investments of some of the funds have been in buyouts. What's your take, if I may start off with? What's your belief? How's this evolved for you, basis the experience that you've had across not just India and Asia?
Thanks, Anurag. Good morning, everyone, and it's my pleasure to share the stage with my dear friends Ashish and Param. Let me just give a step back on Blackstone. We started our office in India in 2005. When we started, we dabbled with various strategy. At that time, the private equity industry in India was not mature. But soon we realized that we need to figure out what we are good at. And in 2012 is when we pivoted towards control strategy. And from 2012 till now, so last 14 years, we would have done 40 plus investments in Asia, and all of them are control or control oriented investments. And that has rewarded us quite well in terms of, if you look at the returns, 20+% dollar IRR, and many of you might have seen Steve quoting publicly in all the forums that India is the best performing geography for Blackstone globally. So that's the evolution which we have seen within Blackstone. And if you think about the industry in India, I would say that there are three phases we have seen, which is first phase of, let's say, 1995 till 2010, which is the early stage, global firms coming into the country, dabbling with various strategy, etc. 2010 to 2020 is where I would call stage of consolidation. Firms trying to figure out and consolidate their strategy, many of the domestic firms like Kedara, etc., coming into the market, growth and VC investments coming into the country. And from 2020 onwards, what I call as phase of acceleration. So in terms of deployment velocity, Asia funds being raised. Right now we are raising our Asia 3 fund, and it's about $13 billion, twice the previous fund size. And the way we have seen, Amit Jain spoke about the evolution towards buyout market. And I think the issue, one is we talk about the founder succession, etc. Second is the changing landscape. But in my view, what is another most important thing is the development of the whole ecosystem, which is basically earlier, if the founders were not confident of ceding control to the PE firms, because PE firms were not ready. But now, PE firms have invested in the operating capability, developed the management network. So there's a whole ecosystem which kind of works well with everybody. We have enough and more examples where, founders have sold, let's say, 70-80% stake to firms like us, maintaining 20-30% stake. And the value which that 20-30% has created is significantly more than what the 100% stake would have created. So we have seen that whole ecosystem coming in play, and I think that's what is driving the whole buyout space.
So it's a great collaborative partnership between the founder family and the PE firm. Ashish, coming to you, do you also sort of believe in buyouts as an investment philosophy? What has changed according to you in India over the last few years? I mean, Amit mentioned about the 3 phases since 2020. Is it also about the ecosystem, or is it about more macroeconomic play that India is sort of going through, the confidence of past experiences? How do you see this whole playing out, buyouts playing out?
Yeah, no, look, I think I'd build on what Manish said and a little bit of what Amit said as well. Sorry, particularly what Manish said. If you think about, the journey of private equity in India, it often did start off with minority stakes. I think the approach some funds like ours have taken is what you do is the same whether you have a minority stake, significant minority stake, or control. It's the how you do it that really shifts. I think that's the basic philosophy with which certain funds, buyout funds from the US have come in, have sort of taken to the Indian market. I think that's been the core of what we've thought about. So if I look at our own journey, we started with significant minorities, we then went on to control, and today we do a blend, but probably more buyouts and more control. What hasn't changed is, today a third of our team in India is what we call the portfolio group or the value creation team. So 1/3 of our 30 plus people team in India is focused purely on working with our companies and driving value creation. If I think about our investment committee, we have a permanent member from the portfolio team on each investment committee. So that right from the beginning, there's a lens on what is it that we're really going to do with these businesses, which I think then sets the foundation for all the value creation that happens. So yes, I agree that the market has definitely shifted towards families having a preference and openness to getting in investors like us for control. But, like Amit was saying, a lot of that foundational enabling stuff has also happened within funds and within the ecosystem to enable that, which has been great.
Understood. Okay. Param, do you exactly see the same way? What really do you bet on when you consider a buyout? Is it, Manish mentioned about capability building, Amit Jain spoke about the whole product market fit. So entrepreneurs are very good at building product market fits through. And then do you see yourself coming in and betting on product capability, or is it professionalization of that business? How do you really create value when you consider a buyout scenario?
No, I think to just adding on to what Amit and Ashish just said, right? So as ChrysCapital, our journey has mirrored as one of the oldest private equity firms in the country, right? Our journey has mirrored the industry itself. We started off mainly as a minority investor, to be honest, right? But I think the vision was clear that we wanted to get into buyouts because the market was shifting there. And about almost a decade back, we started building our operating capabilities to what Amit said, right? Which meant also we started bringing this lens of, let's say, what we call as an operating diligence, the report that you've just released. We started doing that almost about 8-9 years back to understand what can we add as operators into the business that we're investing in from that perspective. And I think fundamentally, the perspective or the shift that is needed for us, to Amit's point again, is the fact that in a buyout, you become the primary risk taker in chief, right? So that's where I think for us to kind of also think through some non-conventional levers while, let's say, you're betting in a minority construct to say, let's go ahead, there's good industry, good firm to go in. The question here is what can we add, right? Can we add a new business? Can we add a new geography? Can we add a new product line, etc.? And that pretty much gets defined in the diligence itself, for us at least, to figure out what can we do differently to get outsized return to what Amit's point was initially as well.
Fantastic. So it's very clear. I think we've heard Amit, Ashish, Param, that there is a great deal of confidence in approaching deals with a buyout mindset. So I think if we move on, the big thing is now how do you really create value? You have. There seems to be consensus that we are all in for buyouts. You mentioned about the depth of the operating teams that are being built. How else do you really sort of create value? Have you really built a playbook over time? Do you think, whether it's the performance incentive structures for management, whether it's a suite of external experts, bringing in professional CEOs, bringing in best practices in governance, how do you really go about creating value? We did see Manish and Vimalji speaking about it, irrespective of the stake. How do you really connect with that? So Amit, coming back to you, have you, apart from building operating teams, how else have you sort of build capability in your operating teams to create value?
Yeah, so our strategic framework to create superior returns is basically buy right, build right, and sell right. And for building right, we have the entire operating team, and as a global firm, we have almost 100 professionals within Blackstone and 120 senior advisors who work with us. And I've been with Blackstone now for 16 years, and over this period of time, have seen different industries, different companies, different businesses, different markets. And it's like a playbook. Now one could get a sense of that this works well. And typically in any of the company, there are 5 levers which we play on. The first one is revenue acceleration. So we all know that in this market, growth is what is going to get you the right multiple. And there are enough and more examples of like Emphasis, which is a IT services company owned by us, where when we bought it from HP, revenue was declining by 4% per annum for almost like 12 quarters. Our investment committee gave us tough time that why would you like to invest in a company which has a declining revenue, etc. But you have a own CEO candidate, and you have a story that what you can do in this company. And last 9-10 years, it's been 10+% growth. And I think on revenue acceleration, one thing which I feel great pride of is what we call as power of one Blackstone. So we have 270 plus portfolio companies. We have network of advisors, board members, bankers, people whom we can reach out to, etc. So we develop and nurture this network. How can we help our companies? For instance, our US companies are looking for, there are many SaaS companies we have invested in. They are looking at cost optimization, efficiency improvement. Our Indian companies provide those services. So bringing them together, creating a win-win partnership. So we kind of run this as a proper program. So that's one lever. Second is operational excellence, productivity improvement, cost optimization. The third pillar is tech transformation, where what we've seen is tech not just as a vertical to invest in, but a horizontal capability which cuts across companies, across industries, and how it can fundamentally change the business model. And we have seen like companies like Sona Comstar, which was traditional internal combustion engine auto component supplier, and becoming a largest electric vehicle auto component supplier. And we made like 15 times return on that investment. IBS software, from a licensed software to a SaaS software. So how can you leverage technology to transform the business model? The fourth pillar is M&A, but I think the fifth one, which is the most important one, which underlies all these initiatives, is basically to have a best-in-class leadership team. At Blackstone office, I can think about all the strategy, etc., but nothing will happen if you don't have strong, capable management team on the ground. And at times, I feel like we run a recruitment firm, hiring some 40 to 60 executives and board members across our companies. But that's a big muscle which we have developed, and that, I think, makes a big difference to the returns which you are able to generate in the firms.
Fantastic, I think. So, Ashish, just on this point on leadership, right? There is always a lot of incumbency in many of these portfolio companies when you get in. Obviously, there is strength of that incumbency. They understand the operations, they understand the product and the market better. But at the same time, there'll always be this challenge of change management, of evolving as the portfolio business grows. So these softer aspects of leadership, of management capability, talent in the organization at the senior to the mid levels, how do you really tackle that? I mean, is that something that as you've operated some of these portfolio companies, is that a big challenge that you see?
Look, I think, as Amit said, it's an incredibly important part of how you add value is whether you've got the right people and you've set them up for success and you're managing them well. If you think about an average private equity journey, it's 5 years, 20 quarters. It takes you 3 or 4 quarters to understand the business, understand what's going on. Then you've got, let's say, 12, 13 quarters to do your work because you need another, 7, 8 quarters of stability to exit, right? So you've got a very short window to drive a bunch of change. And therefore, right at the beginning of the investment, being clear on, is this a situation where we're going to back an existing management team, or, as Amit was mentioning, as part of the underwriting, do we need to find and back a new management team, becomes incredibly important. So right up front, during underwriting, we spent a lot of time figuring out which of the two lanes are we going in to. Once we're in there, by the time we get to our final investment committee, you have a pretty clear sense based on a different set of tools we use and structured discussions we have, where you've got a hypothesis on what the go-forward team needs to be. Now, once you're in the first 6 months, we are literally, as a deal and portfolio team, connecting every week and assessing whether we've made the right call on management. Because, if you decide you want to make a CEO change, it'll take you, again, a couple of quarters to find a CEO, notice periods, then it'll take that new CEO another couple of quarters to ramp up. You've lost a year and a half, right? So if you have to make that decision, make it fast. So I'd say there's an incredible focus on getting it right. It is an art and a science, because to be honest, you can't be too scientific with it. You can make both work. You can go in with an existing team. You can find a new team. If you're going in with an existing team, then I think your question is very relevant, which is how do you increase the heart rate of that team? Yeah. Because ultimately, again, time, as cliched as it is, time is money within a private equity context, and how quickly you can drive the change is as important as the magnitude of change you can drive. So again, we've got a way in which we gradually get an existing management team, if that's the path we're going, to start operating at a different level, right? And I think that's where the partnership we have with our value creation team, who embeds themselves in the companies, I think that helps. The last thing I would say on this, on this point is, often when we're building new management teams, you end up hiring, the best sales and marketing guy, the best ops guy, the best HR person, all coming from best-in-class companies, each which has its own unique culture and its own unique way of doing things, right? So we also spend a lot of time, again, an art and a science, we've developed certain tools on how do you not just have a collection of A players, but an A team. And in the first 6 months of a team's journey, we go through we call them structured journeys with our teams to get them together, to get them, completely behind a shared vision of where they want to go, and get them to operate with each other differently. Because until you get that right, the team won't be able to deliver what you need it to deliver.
So just picking on that, Ashish, just what you mentioned, when do you really build a value creation plan in a buyout context? Is it something that you create upfront before the investment and get it approved with the investment committee, as well as get buy-in with, let's say, the founders or the CEO and the management team? Or is it something that you take a couple of quarters to sort of detail out fully? Your investment thesis is clear, but the detailing of the plan and the buy-in happens later. How do you really time the whole thing?
See, I'll give you an honest answer, and it depends on, again, is this a significant minority control? During the diligence phase, you're buying and selling. You're buying a company, but you're also convincing an entrepreneur or a family or a promoter to work with you. And by definition, that process is, call it 6 to 12 weeks, where you're trying to really understand the business and build a view. So by the time we get to our final investment committee, you have a value creation plan. You have a sense of, look, these are the 4 or 5 big things we need to do to transform this business. Revenue acceleration being an example, margin improvement being an example. Yeah. There's also a sense you have on what are the foundational building blocks that need to be improved. So for example, IT, tech, you'll have a little bit of a hypothesis saying, it's a yellow, we need to work on it. So final investment committee, you'll have a value creation plan. And based on that, you'll have an investment case that drives your returns, and the IC gives you approval. The reality is, when you get into a business, it's like you're dating and now you're married. You discover more about the business. The competitive environment changes, the macro changes, government policy shifts. So over the course of our investment, the value creation plan is a living, breathing document. It's almost, and it's the job of what we call the portfolio team at Bain Capital. We call them quarterbacks or team captains. It's the job of that person to keep that refreshed. So, you're 6 months in and you realize we thought there was a big pricing opportunity. You did the work SKU by SKU and you realize it's 3%, you're underwritten 5%, there's a gap in your value creation bridge. Then it's your job to say, what else can we do, right? So you have to think of value creation as a living, breathing sort of document that you keep current. You keep it current at the beginning, you keep it current during the investment phase, and even when you're getting ready to exit, you have to have a value creation plan ready for the next buyer, right? So I think, again, people think of it as a static document. It's not. It's a living, breathing document, and at least in our context, it's the portfolio group's job working with the deal team, the founders, the management team, to synthesize and have a view on how we're going to make money in this deal, given everything that's happening now.
And do you need to course correct as you go through this?
All the time.
All the time.
All the time.
Or you back the same plan and you believe, no, it's an execution challenge, or do you think, no, we've got to get the strategy revised? How do you course correct?
I'll give you an example. At L&T Finance, when we invested, we had a hypothesis that we should sell the asset. And they had an AMC, a mutual fund business, and we said, you have to sell it. So that was our underwriting. We had already spoken to a few bankers. We knew what value could be generated. We had aligned with, the parent. But we got in and, our CEO said, look, I really don't think we should sell this business now. There's another whole wave of value creation we can do, and we can double it, triple it. So we course corrected. We said, okay, let's not. And that was the right answer. We sold the business, a couple of years later. We made 3 times what we thought we would have made with that particular slice. So you have to be dynamic. And at all points in time, you have to be nimble enough to know, what you thought was right and is not. And that's that's also an art and science, right? Because if you thought there's a big pricing opportunity, you're 6 months or a year in, you're not seeing it. Either you can keep at it because maybe you can actually get it, or you be practical and say, not the right idea, let's move on to the next idea. So that's always a challenge.
Interesting. But I'm coming to you. The importance of diligence in a buyout, right? How do you look at when you do diligence? Obviously, many times it's a competitive context. Timelines, like Ashish mentioned, are short. There are hard assets and then there are soft assets. How do you really the importance of diligence, the level of detailing that you go into, whether it's operational or strategic, sectoral, macro, as well as the business, the management team. How do you really approach diligence in a buyout context? Is it very different? You did briefly mention 8-9 years back you started doing, let's say, operational diligences. The softer aspects is extremely important, and you might not have time. You don't know whether you have the right management team. You don't know whether the leadership is right or not, whether the direction. So how do you go about it in a time constraint?
No, so that's actually one of the most important aspects before we invest, right? To Ashish's point, we should have a framework or a sort of a broad value creation plan which we should at least underwrite at the investment committee, and then post that in the first, let's say, couple of quarters, we chalk it down like to the nth level so that we know the how of what we'll get, right? But to be honest, diligence is probably the most important time where we need to assess not just the opportunities but also the risk along with it, right, from that perspective. So over a period of time, we've developed our toolkits like Ashish was mentioning, whether it's on the margin improvement levers, pricing levers, etc. But more importantly, I think, again, I'm just relating to what Amit just said, almost 50% of the time post-deal goes into recruitment for the team, right? And that's the same kind of ratio that we spend pre-deal as well, where whether it's management assessment or even what we firmly believe in just as a philosophy is hiring for the future. So if we are taking this business from X to 4X in about 5 years, there'll be many opportunities where you will have to kind of add new layers or new structures. So we just trying to understand those gaps in the organization as well, right? Because at a smaller scale, it's easier for me to manage, let's say, through 3 BUs to, let's say, Ashish's point. But if I really want the AMC business to flourish, I might want to assess and hire the right leader at that point in time, which may not be commensurate to the scale of that business that time. But that's what you're hiring for the future. So assessing the gaps in the org, not just for today, but also for the, let's say, 4X size, assessing the management, not just for today, but also for the later, does take a lot of time, apart from, let's say, assessing if there are white spaces in terms of revenue acceleration opportunities, if there's a margin improvement, again, going SKU by SKU, doing the assessment at scale, maybe 2X of your scale, would you get more economies of scale? All of that gets chalked out, but I think the rubber hits the road post-deal when you chalk it out and make it an nth level plan in probably a couple of quarters post-investment.
I'll come to you, Amit. Now we're getting a little candid. What have been the kind of, I know you mentioned 20% plus dollar IRR, fantastic sort of scale up of investments, portfolio companies. I'm sure there'll be failures, some investments which didn't go right. Any examples, any reflections you have and the learnings that came from that, especially in the Indian context?
I think, as Ashish also mentioned, there are enough and more case studies and examples which you come across where what you thought you are underwriting and what you thought is the business turns out to be very different. Maybe because of external factors, maybe because of internal factors, but whichever way. And you have to deal with it. And therefore, what do you do thereafter? And as Ashish rightly mentioned, that strategy planning is like a living, breathing document which you live with. And one of the things which we do in every company is that pre-investment, you have a management case which management has represented. You have a IC, investment case, which investment teams have put together after doing some haircut, etc. But then once you get into the company, you create one document, one strategy document, which is effectively signed off between the management team, investing team, and operating team. And then every year, you look at that strategy, whether the business is on course and requires some course correction or not. I'll give you one example. One of the companies which we invested in, a company called PGP Glass. It's a specialty glass bottle manufacturing company. We bought it from Piramal Group. Yeah. They are obviously astute businessmen, so everybody thought that, what are we going to do with the business? But we had our own playbook, our own thesis, what we can do with this business. But immediately after buying this business, COVID hit, supply chain got disrupted. International freight rate, so a container from India to US, which used to cost $2,500, became $15,000. And freight cost as a percentage of revenue from 7% became 30%. So effectively, entire EBITDA was getting wiped out. Management team was getting stressed out that Blackstone has just bought it, and the EBITDA is getting completely wiped out. What will happen, etc. And we worked with the management team that it's fine. It's an external event which has happened. I still remember that globally we had a list of companies, what we call as red list or watch list, and this company featured in that. So I had to present to John Gray, our COO, saying that what are we doing in this business and how will we bring it back on track. But the fact is, as everybody mentioned, that we come from a position of partnership. It's not the owner-manager culture. It's about partnering with the management team and trying to seek a solution to the problem what you have. So whether you have to take price increase, cost rationalization, whatever you need to do, you put in place all those enablers. And now, obviously, with the geopolitical issues and the tariff coming in, so this company has seen enough and more in the last 4 or 5 years. But the fact is, right now, EBITDA of this business is 2.5 times of what it was when we bought this business. Things have changed. Management team is the same management team which was there when we invested in this company, but working together with a partnership approach, finding the solution, trying to get whoever could help, whether it's a consulting firm, whether it's an advisor, whether in the European and US market to open the door in the new customers, can we get somebody on the board, etc. So find whatever you can to help management achieve the destiny what you think you can get to. So there are enough and more examples where things have not played out as you wanted, but you effectively have been able to correct. There are still some situations where it has not got course corrected yet, but that's our job to get that on track.
Fantastic. Let's just move on to the important, I would say, elephant in the room always, which is technology and AI. Right? We are seeing the impact of AI, the enabling powerful capability that it could bring, or the disruption it could bring to value creation plans in a sector. We've seen how Anthropic and Claude have suddenly change the value of an IT services business and so on. So there is a lot that is happening which is driven by AI. Does that change your investment philosophy for any of the sectors? Do you see that as something that you would want to wait and watch out how it plays, or you continue to still go with your plans, saying that we got to build an all-weather portfolio and we will sort of deal with this as we will leverage it? I'm sure there are winners and losers, and you'll leverage it as you go along. Or are you a bit more cautious about it as you build your value creation plan in your existing portfolio, as well as some of the new assets you might be looking at?
Yes, of course, this is the hot topic, and as a firm, we are investing a lot in the what we call as picks and shovels, and not directly investing necessarily in the AI companies. But if I look at the portfolio right now, I would say there are two types of companies what we have. One are the companies where there is an existential issue, where it's about, you have to have AI as your friend, make it embed as part of your business, otherwise the model could get disrupted. IT services, BPO companies, etc., which we have invested in, if you don't do that, you will have a major impact on the business. And then you have set of companies which are, let's say, more industrial companies or financial services where you can look at processes optimized with AI. So commonly these days I say to our companies that with AI, either you double the growth rate or you reduce your cost by half. Now you choose which one do you want to go. Obviously these are extreme cases, but that's what we want to drive with the companies. We have our global head of operating team, Rodney. He comes from McKinsey and he used to head digital and AI there. And there are, every company we are saying there are 5 things on AI. Every company is having AI strategy. But I think there are 5 features which we are saying are important. One is the top-down commitment. So as shareholder, board, CEO, you have to be committed to it, and it's not the CIO, CTO function. Second is business-first approach. It's not a science project.
Yeah.
So let's not keep investing money and not looking for, so what is that which will move the needle on the business side, and therefore make those projects as something which you want to go after. Third is having a clear ROI. What's the return which we are expecting? Time-bound manner, clear, measurable KPI, etc., which you have to track. The fourth thing is data as an asset. We all in private equity talk about AUM. Now there's a new word called DUM, data under management. So you have a massive scale of data, etc. How do you optimize that data and make this work, right? And finally, path to scale. There are projects and pilots you can keep doing. Eventually, it has to give you tangible, large, replicable business model which you can incorporate across the organization. So those are the 5 parameters across which, based on which we are evaluating AI strategy of each of our companies.
Fantastic. Ashish, you mentioned 12 quarters, right? So technology and AI, are you able to really drive change and value through in a short span of time?
Look, I think there's a lot more emphasis now on this topic. I think there's 2 parts to it. One is just the simple tech backend, because I think in many of the businesses we invest in, particularly in financial services, it becomes quite critical to have a tech stack that works, makes sense, is relevant. Often that entails lots of investment, so making sure you prioritize that investment and get the right bang for buck. So there's a lot of thinking that happens up front there. That is a multi-year journey, and you have tech debt, etc. So I think the question is, how do you get your companies on that journey quickly? Will you see all of that play out? No, but I think it'll allow you in the first 2-3 years to see bulk of it, where you start seeing benefits from it. I think on the AI topic, we take a pretty similar approach to what Amit laid out, which is there's a bunch of industry verticals where the impact is imminent and obvious. IT services being a great example, and we have a set of lean in, lean out investment themes. We don't, particularly, for example, revenue cycle management is something we've stayed out of because we feel structurally that will be very impacted. So there's a bunch of investment decisions we now make around that. I think there are some obvious functional use cases that are emerging where that if you put in the money, you will get an ROI. If I give you an example, customer service, chatbots, within our software businesses, coding copilots. So there's a bunch of these, what I would call now proven functional use cases where we lean in hard, and you have a sense of that when you're doing your underwriting. Then I think there's a little bit more of piloting approach in industries where we feel either processes can be fundamentally transformed. But I would say there it's a little bit of test and learn. We own a retail business in Japan where if you think about it, every handbag and every shoe has to be modeled, and they're different colors, so you keep taking photos. It takes time to put your catalog up. We were trying to use AI-generated models to quickly move from product to catalog and to online. And what we found was, it kind of worked for bags, but it didn't work for dresses because it didn't fall on your shoulders well. So that sort of R&D experimentation we keep doing, and then we take that across the moment we think we have scale and a use case that works. But that is a little bit more episodic. So that's how we've thought about it.
Very interesting. Param, any experiences on tech and AI?
Yeah. No, I think like Ashish mentioned, we've been doing some pilots ourselves across portfolio companies. I think for us, what's critical is, one is obviously the functional lens. So if there's, let's say, something you've done on customer service, how we can take it to the others. But also there's a little bit of a sectoral lens. For example, there are sector-specific use cases which have emerged and have delivered value. Marketing, for example, in consumer is one of them. right? How quickly can you generate your collaterals? How much can you use AI to kind of decide where you want to push them, and so on and so forth. So can we take those sectoral ones also across is the second lever. So we're trying to create what we call as playbooks, which we can then execute and kind of accelerate across the portfolio companies. And it does help to have some of the IT services companies where we've not just taken this thing head on to improve our own operations, but actually created them into a service line. For example, for Zorient, today data and AI is almost a 30% vertical. So that helps because they're doing this with the best-in-class companies in the US. So you can always leverage them saying what are the use cases working in a sector, in a geography, which can we pull in back to our own portfolio companies as well.
Fantastic. So all in all, I think we're running out of time. It clearly seems, and maybe some last comments, when it comes to value creation, it looks like there is great comfort. There is a repeatable playbook that you have, irrespective of sectors. And like you said, you'll continuously evaluate investments into buyouts, into controlled deals, and value creation on the back of that. Is that a fair statement? Do you believe you have a repeatable playbook now?
Look, I think that's a very abused word because everybody uses playbooks. Look, I think playbooks are effectively pattern recognition, right? So if you've done something again and again and again, it makes you faster on identifying issues, solving them. To me, any private equity fund you speak to globally right now will tell you with where public markets are, it's very important to generate alpha. Alpha will come if you do things differently under your ownership, and value creation now will be a big differentiator. So I think you'll hear that, and you'll hear every fund saying we've hired a lot of people. In my mind, I think what will define funds that break out in the next 5 to 10 years, there's the hardware piece, right? The hardware piece is, do you have an operating team? Do you have replicable playbooks, i.e. lessons learned that you can use again and again? Do you have an ecosystem that works? That's the hardware. I think the really important thing is the software, which is how integrated is your value creation team culturally in the investment process, as a team with the deal team. And how stable is that team? Because ours is a business where you do 3 deals, you build judgment, you figure out how to get things done. So longevity is very important. It's like wine. So I think the software of how funds build out their value creation capabilities, I think will be much, much more important than the hardware.
I don't think I can add anything to what Ashish said, but I think 2 things which to come to my mind is one, and which has worked well in the past and will be important going forward, is alignment, and alignment. So I remember Manish talking about between the operating team and the deal team alignment, operating team and the company alignment, but whichever way, we all need to have one common goal which we are all going towards. It just becomes easier thereafter for everybody to work then accordingly. And second is just given the amount of changes which we are having and we talked about how some of the macro environment has changed and companies are coping up with that. I think building agility in the company in terms of how do you respond to changes quick enough and not get into the bureaucratic long approval process and analyzing the last dollar and the penny and take some of the time gutsy calls and just move forward. That's important. So building agility within private equity firm and the operating company, that will be another thing which will be important.
Probably the only other aspect I would want to highlight, because I think Ashish and Amit have covered everything that probably has to be said, is the mindset shift, right? To be honest, one of the alignments that we definitely try and do with the management team, internally with the investment committee and operating team, is the level of investments needed. Because now as an owner in a buyout, the mindset has to shift from making it a linear growth curve to willing to take bets which will probably take, let's say, our EBITDA down also if needed for the first year or so, or the second year, in terms of investments that you need to build out certain new capabilities and systems in the organization, right? And that's something that we should be ready to do, and that's where the alignment comes in a lot more handy.
It's been a fantastic, insightful conversation. I think since we're just about time or around